January 29th, 1973, Washington, D.C. Dentists, jewelers, and other commercial users of gold have to pay more for their precious metal, partly because a psychological link still exists between official and private gold. That link will continue until the future role of gold is finally defined within a reformed international monetary system. Pending that definition, says David Williams, the private gold market is likely to remain unstable, subject to pressures similar to those that pushed up the price of gold to $70 per fine ounce last August. Gold today costs less, about $65 an ounce, but the underlying instability is still there, according to Mr. Williams, Assistant Treasury of the International Monetary Fund. Private demand for gold steadily grows, while the world production of the metal remains stable, with old mines being worked out and few new discoveries being made. This also pushes prices up. The result is a tight supply-demand situation, overhung by uncertainty as to what will become of official gold stocks that belong to central banks. Governments hold in their vaults the equivalent of about 30 years' output of the metal. The United States alone owns nearly $10.5 billion worth of gold. What would happen to supply and demand if gold were demonetized and the United States and other nations were to sell some of their official gold on the private market? Commercial users of gold have pressed the U.S. government to do just that. Treasury Secretary George Shultz has made no commitment, nor is any likely until the IMF agrees on the future role of gold. In most fields of technology, writes Mr. Williams, no substitute for gold appears to be in sight, so commercial buyers, notably the defense and aerospace industries, jewelers, dentists, plus speculators and private hoarders, are likely to keep on competing for limited supplies of gold. The relative scarcity of gold led originally to its monetary function as a commodity of stable value against which other commodities and world currencies could be measured. Then, as economic growth, including burgeoning international trade, required government to maintain larger reserves, doubt rose over the ability of scarce gold to continue to serve as a fixed numerary. These doubts grew as the dollar weakened and climaxed in November 1967, when devaluation of the pound sterling caused private investors to buy about $3 billion worth of gold from the gold pool maintained by the 30 central banks, the largest share of gold coming from the United States. The following March, these central bankers met in Washington, ended the gold pool, which had supplied gold to private users, and created the two-tier system. Central banks would continue to settle official transactions among themselves at $35 per fine ounce, but no longer would sell gold to the private market, which would be allowed to float up or down according to supply and demand. Separate circles, commented Paige Nelson of the U.S. Treasury, were drawn around monetary gold and around private gold. Then, in 1969, the IMF created a new reserve asset called Special Drawing Rights, SDR, or paper gold, with each unit of SDR equivalent to 0.888 grams of fine gold. SDRs are added to the book value of a nation's official reserves as a percentage of that country's subscription to the IMF. The function of this new paper gold is to increase international liquidity in an orderly way. The next major step occurred on August 15, 1971, when President Nixon closed the gold window, meaning he suspended the convertibility of the dollar into gold, in order to avert what were potentially huge demands on the U.S. gold supply by other central banks. The move was also part of the U.S. plan to get a dollar devaluation. In December 1971, the Smithsonian Agreement confirmed a reshuffling of exchange rates, including a devaluation of the dollar, which changed the official price of gold from $35 to $38 per ounce. There the situation stands, with Treasury Secretary Shultz promising U.S. leadership in the effort by 125 nation members of the IMF to redefine the relationship between gold, SDRs, and the dollar. The aim is to achieve agreement, at least on principles, by this September, when the IMF convenes in Nairobi, Kenya. Meanwhile, according to Mr. Williams, the free gold market, now divorced from monetary gold, went through three distinct waves of change between March 1968, when the two-tier system was introduced, and August 1972. For the first 16 months of the two-tier system, ending May 1969, the price of gold rose about $44 an ounce. This period was marked by uncertainty as to how the new arrangements would work, particularly since South Africa, producer of more than 70% of the Western world's new gold, declined to adhere to the two-tier system. Between the end of May 1969 and the beginning of 1970, gold prices, influenced by a variety of factors, including sales by South Africa on the private market, sank to about the official $35 an ounce. There, the price hovered until September 1971, just after Mr. Nixon closed the gold window. The ensuing world monetary crisis drove gold prices up sharply, with a peak of $70 per fine ounce being reached in August 1972. Accelerating the price rise was a dwindling supply of gold for sale in the free market. In September 1972, the IMF met in Washington, and Mr. Schultz signaled U.S. cooperation in reforming the international monetary system. Since then, the free market price has declined to about $65 per ounce, but market stability is fragile. As commercial use of gold expands and the world waits to know what official role the yellow metal will play.